Hey, what is going on, guys? If you're new to the channel, welcome. My name is Nick, and today we're going to be talking about the top 5 best passive investing strategies this year that'll involve low effort and high returns. Now, I just want to be upfront with you guys from the get-go. In this video, I'm not going to be talking about low returning investments. For instance, bonds generally don't return high returns. GICs if you're living here in Canada, CDs for the US, and not even high interest savings accounts, even though I'm a huge fan of them. At the end of the day, nearly all of these investment types will barely beat the rate of inflation, which is typically about 2 to 3% per year. So as investors, we need something that's actually going to make us money on top of our existing money after inflation every single year. But by the same token, we don't want to spend all of our time trying to create a business or create some type of investment that's going to make us a huge return. We want to have something that's passive, where we can live our lives and let the money grow by itself. So the strategies that I'm about to talk about in this video have been proven to yield decent returns over the past 10 years, and actually very high returns in some cases, but will require very little effort on your behalf. Now, of course, you're not going to find an investment yielding a 15% year-over-year return with the risk level of a high interest savings account. I'm pretty sure that just doesn't exist. All I'm trying to say is that some of these investments that do yield higher returns will involve some risk that you will have to take, so it does depend on yourself as the investor and what your risk tolerance really is. Because when you aren't taking that active approach to investing, you can't specifically control your investment. You're taking a more passive approach and sitting back and relaxing, and so that's just something for you to be aware of before getting into this video. So if you do enjoy, make sure to give this video a big thumbs up to help with the YouTube algorithm and to bring out these passive investing strategies to many more people. And if you haven't already, definitely consider subscribing down below for more weekly videos just like this one. So with that said, let's jump into the top 5 passive investing strategies that I have in mind. Alright guys, getting into the first passive investing strategy that we have on the list today, and that is to invest in a REIT. REIT simply stands for Real Estate Investment Trust, and it's a company that generally owns and operates real estate or real estate related assets. Just like you can own a portion of a company by buying into that company's shares, a REIT allows you to own a portion of real estate by buying into that REIT's units. And if you've ever wanted to own real estate without having to deal with the struggle of managing tenants, paying for your mortgage, or even dealing with stupid little expenses like buying furnace filters, buying into a REIT is probably what's best for you. Now, there are 2 major types of REITs that I want to talk about today, the first being equity REITs and the second one being mortgage REITs. Now, equity REITs are the most common types of REITs that you're going to find, occupying about 90% of the total REIT market, and these are the ones that invest in hard real estate assets. And that implies that all of their income is derived from renting out these real estate properties that they own and then collecting that rental income. Now, on the other hand, you have mortgage REITs, which actually occupy less than 10% of the entire REIT market, and these ones invest in mortgages. And so the income that they earn is generated from the interest payments on their mortgages that they own. Now, in this video, I'll only be focusing on equity REITs because they are the most common and vastly bought into, but also they're the most easy to understand for the average investor. As a REIT investor, you can choose to invest in REITs that operate and specialize in many different areas of real estate, such as residential single-family or multifamily properties, commercial healthcare properties such as hospitals, retirement homes, etc., commercial retail properties such as shopping malls, retail stores, etc., and then finally commercial office buildings. Now, depending on the type of REIT that you want to invest in, the risk level is of course going to vary, but in my opinion, it's only between low and medium risk. For instance, if you find a company that invests heavily in residential real estate, it's probably going to be lower risk than if it's commercial. Because everyone is always going to need a place to live, and there's so much demand for residential real estate, whereas businesses can go bankrupt, and that's where the risk comes in with commercial. Now, the benefit of investing in REITs is that they generally have very high dividend yields, and that's because the companies are required to pay out 90% of their net income to their shareholders in dividends. Along with that, you can find REITs that do provide moderate capital appreciation if the management is really effective in deploying their capital. For instance, if we take a look at Northview Apartments REITs, this is one that I've been looking into very closely recently. They have had a lot of capital appreciation, but their dividend yield is well above 4% as well. So on average, the returns of REITs can be similar to individual stocks, but will generally be lower because they are paying out so much of their income in dividends. so typically it's about 8 to 10% per year. Now, although I'm not a REIT holder right now, I would plan on buying into one if I could find a good deal in the market. All right, guys, up with passive investing strategy number 2 today, and that is to invest in ETFs or exchange traded funds. An ETF is simply a basket of stocks or many other assets that trade as a single ETF, like a stock on the stock exchange. And what's great about ETFs is that they're very well diversified, so you don't have to worry about one investment falling and then all of a sudden losing all of your money because you had everything tied up in that one investment. An ETF is broad diversification amongst many different companies or other assets. And generally that means that the risk level is going to be low, in my opinion, for most ETFs because you're so well diversified across the asset classes. Now, you can actually pick and choose ETFs to target the specific area that you want to invest in, such as technology, healthcare, etc. Or you can actually have an ETF track the performance of an index, for instance, the S&P 500 index in the US. Now, typically the average returns that you're going to find in an ETF is between 8 and 12% for a compounded annual growth rate. However, the S&P 500 itself does average about 7 to 10% per year over the long term. Now, the other advantage of buying into an ETF, and this is a huge one, you will see very low investing fees. Now, your average ETF typically has a fee that's less than 0.5% per year, and this would be called the management expense ratio, or the MER. Now, contrasting this with an actively managed mutual fund, you might find fees upwards of 1 to 3% per year. And to be honest, it's been proven that mutual funds really don't outperform ETFs or the indexes on a long-term basis anyways, so you might as well buy into the ETF with much lower fees. So giving you guys an example of one of my favorite ETFs ever, and that has got to be the Vanguard S&P 500 Index ETF, ticker symbol VOO. Now, since its inception, this fund has had a 14.9% compounded annual growth rate, which is absolutely insane. But of course, that probably doesn't take into account all of the recessions that happened in the S&P 500 over the past history, so you definitely have to take that into account when looking at the past returns. Now, for my Canadian friends out there, the best alternative to VOO would be the one that trades on the Canadian Stock Exchange, and that would be the Vanguard S&P 500 Index ETF with ticker symbol VFV. And it's pretty insane looking at these returns. The fund has basically gone in a straight line up since 2008, which is absolutely ridiculous. So overall, guys, this is one of the best passive investing strategies that continues to prevail year after year. And one of the best ways to do it is by dollar cost averaging into your position and continuing to buy every single month to be able to build up your portfolio and continue getting the gains year over year. All right, now the third way to generate some extra passive income through your investments is actually another type of real estate investing, and that would be called real estate crowdfunding. Real estate crowdfunding is simply a method of gaining capital to fund a real estate project with the help of the investors, also known as the lenders. So as the investor, this can be very beneficial to you because you can buy into these projects that are going up, earn some dividends in rental income, or even capital gains when the property is sold. But most of you are probably thinking, well, real estate crowdfunding sounds exactly like buying into a REIT, so what's the difference? Well, the difference lies in that crowdfunding relies on social media to gain a lot of the investor support, and then you can actually buy into these specific individual projects, whereas with a REIT, you're actually buying into a company itself. So to be able to get into real estate crowdfunding, there are many different websites that will facilitate all of the transactions between the lender and the borrower, one of those being Fundrise. Fundrise is by far one of the most popular real estate crowdfunding websites out there, and it's easy to get started with only $500. And with Fundrise, there's actually very little risk associated with it because you're actually diversified amongst many different real estate projects according to a portfolio that the company sets up for you. Now, the only downside to Fundrise is that there is a 1% annual fee just for having your money invested in that account, which you can't get away from. However, based on many reviews across the internet on Google and YouTube, it seems like this platform is fairly legit and people are actually making decent returns. In fact, the company advertises average annual returns being between 9% and 12% per year, net of fees. But of course, I am just using Fundrise as an example. There are so many different sites out there that will allow you to take advantage of this real estate crowdfunding, such as RealCrowd, which will allow you to invest in individual real estate projects rather than having a diversified group of projects that you're investing in, like in the case of Fundrise. But all in all, I would say that investing in real estate crowdfunding is a little bit more risky than investing in a REIT. And that is because you're jumping into the private sector rather than the public sector where everything is so regulated. And so for for that reason, I would rate this as a medium risk investment. And because of these risks associated with crowdfunding investments, the SEC in the US has imposed limits to how much you can invest into these crowdfunding investments based on the amount of money that you make if you're a non-accredited investor. I won't get into the details of these limits, but I thought I'd let you know just in case you want to invest in crowdfunding. All right, guys, getting into passive investing idea number 4, and that is to invest in dividend-paying stocks. Now, guys, this has got to be one of my favorite ways to gain passive income from my investments because you both have a little bit more control in choosing your investments, but you can also leave it on autopilot and let the dividends pour in. For those of you who don't know, some companies will choose to pay out some of their net income directly to the shareholders, and that is in the form of dividends. And the more shares that you own in a dividend-paying company will result in more dividends being paid to you. Now, of course, the average returns of dividend-paying stocks definitely varies depending on the stock that you want to buy, but you can expect it to mirror the market performance, which is typically about 8 to 10% per year. And of course, that is a combination of both getting the dividend as well as having capital appreciation on your stock that you bought. Now, what I recommend is buying into dividend-paying stocks when the share price has gone down, and that means that the dividend yield has gone up simultaneously, and you can lock in your purchase at a really high yield. And at that point, it really doesn't matter whether the stock price goes up or down, you're still going to be receiving those dividends on a consistent basis, provided that the company continues paying those dividends and you won't have to worry about it, and it's a fairly passive approach. However, it should be noted that dividend-paying companies do not have to pay their dividend. They can actually cut their dividend at any point. They are not required to pay the dividend. I just want to get that in your head. So if you see a stock falling like crazy and the dividend is going all the way up to like 10% or 12%, it might be a sign that the company might cut their dividend because they can't support that dividend with the earnings that they're making. And that is why it's also very important to look at the payout ratio when you're buying a dividend-paying stock. So that tells you how much is the company paying out in dividends relative to the amount of earnings that the company is making. And typically, safe companies have their payout ratios below 60%, meaning they're only paying out less than 60% of their earnings in dividends, and that means that they can afford to drop their earnings and still pay out that dividend. Now, another indicator of a good dividend-paying stock is having a good track record of growth and consistent payments of those dividends. For instance, companies that have been paying their dividends consistently and increasing them every single year for 25 years straight are called dividend aristocrats, and then dividend kings are those who have been increasing and paying the dividends for 50 years straight. So when you find a stock on a list like this of dividend kings and dividend aristocrats, you can feel fairly safe about the dividend continuing to pay into the future. And that's why dividend investing can be a passive approach. When you find a great company that's always going to continue increasing their earnings at a steady rate and always going to be able to pay that dividend, you know that you can sit back and relax and let your dividend income come in. For instance, I'm a really big fan of buying into Canadian bank stocks because they have a great track record of paying their dividends. For instance, I believe Scotiabank's been paying their dividend for over 100 years. Not increasing it every single year, but still paying it for over 100 years is ridiculous. So when you find a company like that, you can rest assured knowing that your dividend payment is going to continue coming in, and then reinvest those dividends back into the company's stock to produce you more dividends in the future. All right, guys, now the fifth and final passive investing strategy that I have on my list today is to get involved with peer-to-peer lending, or P2P lending. Peer-to-peer lending enables people to get loans from other regular people without having to go to a financial institution to get that loan. And recently, it's become a very popular method of financing real estate deals or business deals, etc. Now, you as the investor can take part in these financing activities and profit quite substantially as the lender. How it works is you'll be able to find peer-to-peer lending websites like Lending Club or Prosper, which will connect you, the investor, to one or several other borrowers needing money. Then, depending on the risk level that you're willing to accept as the lender, you can earn varying amounts of interest payments on an ongoing basis. And in order to balance out the risk, the lending platform is going to diversify your investment into many different borrowers so that you're not going to be putting all of your eggs in one basket, and that if someone defaults on their loan, you're not going to lose all of your money. But because the possibility exists that you could lose your entire investment if someone defaults on their loan, I will rate this type of investment as a medium to high rated risk. But of course, with this higher rated risk, it does give you the opportunity to make a lot more in terms of returns. So the returns typically vary between 5 and 15% depending on the risk grade that you want to go for. But personally, I think that the risk reward reward profile of the stock market is a lot better than investing in something like this in peer-to-peer lending. So personally, I'm not going to be doing peer-to-peer lending in the near future at least. I'll stick to the stock market and dividend stocks and ETFs. And with that said, if you guys stuck around until the end, thank you very much for watching. Let me know down below what you thought about these different passive investing strategies. If there are any others that I might have missed, that might perform a little bit better than these ones, let me know down below. And so if you did enjoy this video, make sure to smash that like button for the YouTube algorithm. And then if you haven't already, definitely consider subscribing down below for more content on personal finance, business, and investing in the near future. And I will see you guys in the next one.